Welcome back to the Byte-Size Brief. Today, we're going deep on a company that has honestly been on one of the wildest roller coasters in modern market history. We're talking about Carvana, ticker symbol CVNA. In this explainer, we're going to unpack their incredibly complex Q1 2026 position. We're looking at a business that just posted absolutely record-shattering sales numbers, but at the exact same time, finds itself shadowed by intense accounting scrutiny and a very jittery Wall Street. It's a fascinating setup.
Okay, to really wrap our heads around this, we have to start with a fundamental question. Is Carvana a tech giant, or are they just a car dealership? To truly get this company, you kind of have to stop thinking of them as a traditional car lot that just happens to have a nice website. They aren't just selling cars, they are running a massive industrial logistics machine. Think of them way more like an e-commerce fulfillment engine that just happens to move 2-ton pieces of metal across the country. The entire business model is built on throughput, digital automation, and squeezing all that notoriously painful friction right out of the consumer process.
And honestly, that brings us to the central tension of our deep dive today. Look at the contrast here. On one hand, Carvana pulled off this miraculous recovery from near bankruptcy back in 2022. They posted a massive full-year 2025 revenue of $20.3 billion and even got added to the S&P 500. But fast forward to their latest Q1 2026 earnings release and, well, despite actually beating earnings expectations, the stock plummeted 15 to 20% in after-hours trading. No way, right? Why would that happen? Well, it's because the market is fiercely debating whether this incredible flashy growth is actually masking some deep underlying structural and accounting risks.
Now, from a consumer perspective, the sheer speed of their operation is pretty fascinating. The ultimate goal for them is simple: happy customers getting cars dropped off right in their driveways. A Carvana customer can literally go from clicking Get Started to scheduling their delivery in about 2 minutes. That is the whole Amazon fulfillment analogy brought to life. They've vertically integrated everything: the transport, the inspections, the reconditioning, even the photography. It's woven together so tightly that it creates a massive competitive moat. When it works smoothly, it feels like magic for the buyer.
Let's actually pop the hood and look at how this vertically integrated machine makes its money. First off, they run a 100% digital sales platform. That means significantly lower overhead per vehicle compared to those sprawling, massive physical dealerships. They've also integrated ADESA's wholesale auction network, which suddenly gave them massive physical real estate for fixing up cars. They handle all the inspections in-house. And this is absolutely crucial. They build custom software to automate those rigid state-by-state title and registration processes, hitting a 99% success rate. So their true moat isn't just selling cars online. It's the network effects built into their logistics and process automation that is incredibly difficult for a legacy dealer to just wake up and replicate.
And you can see it in the results. For the 9th straight quarter, Carvana is both the fastest growing and the most profitable automotive retailer out there. They're delivering 40% year-over-year unit growth. Let's put that in perspective. Traditional used auto dealers are currently averaging negative 2% growth. So Carvana isn't just edging out the industry. Right now, they're completely crushing it when it comes to growth and margin.
So, let's get into what actually changed recently. Time for a Q1 2026 reality check.
Looking at the latest financial highlights, we really start to see a complicated picture emerge. On the top line, the numbers are just staggering. Q1 revenue hit $6.432 billion. That is up 52% year over year. Retail units sold topped 187,000, which is that 40% jump we talked about, and net income is sitting at a very healthy $405 million. But you have to look at the bottom metric here. Gross profit per unit, or GPU, actually fell by $155, dropping down to $6,783. So think about that. In a quarter with record-breaking sales volume, the actual profit they are taking home on each individual car shrank.
So, why did the GPU fall? Well, it essentially boils down to a classic margin squeeze. Management disclosed that they're hitting operational execution challenges and bottlenecks in their reconditioning process, which drove up their non-vehicle costs. Basically, as they scaled up so fast, actually fixing up the cars and getting them ready to sell got way more expensive. They're having to pour money into labor training and even AI-assisted workforce tools just to clear these bottlenecks. And Wall Street is watching this super closely, asking, hey, can Carvana really keep growing at 40% without completely sacrificing their unit economics?
This exact dynamic has basically split the market right down the middle, creating two fiercely diverging perspectives. On one side, you have the bull case, right? They see a company scaling profits and leaving the traditional dealers totally in the dust. On the other side is the bear case, which points to hidden structural risks, margin compression, and some serious accounting red flags. Let's unpack both sides objectively so you can really understand what's at stake here.
All right, the bull case. It is anchored in undeniable operational leverage. We're talking about 6 consecutive quarters of 40% or greater unit growth. That kind of consistency is phenomenal. Plus, they are sitting on a massive mountain of cash and resources, $6.9 billion in total liquidity, to be exact. That means they can fund this massive expansion without having to issue more stock and dilute their current shareholders. They also beat Q1 earnings per share estimates, posting $1.69 versus the expected $1.42. Oh, and their debt interest expense? That dropped to just $99 million, pretty much proving that the bankruptcy panic of 2022 is firmly in the rearview mirror.
But then, you see a number like this, $170 million. That is the exact amount of Carvana stock that company insiders have sold off over the past 90 days alone. And you know how many insider purchases there were during that exact same time frame? 0. When the people running the machine are quietly taking that much money off the table, the bears definitely take notice. And that insider selling feeds directly into the bear case, which hones in on structural and legal risks. First off, there is intense scrutiny over Carvana's really complex relationships with DriveTime and Bridgecrest, entities that are actually controlled by the father of Carvana's CEO. This web has sparked an investor lawsuit and even high-profile fraud allegations from short sellers like Hindenburg Research. Now, we should definitely note that Carvana's management firmly denies these claims, stating their own independent review found the allegations entirely misleading. But the bears also point out that Carvana is currently valued at a massive $89.7 billion premium compared to its peers. And critically, remember that blowout Q4 2025 profit everyone cheered about? Bears argue it was heavily inflated by a $618 million one-time non-cash tax benefit, so their underlying operating margins might not be quite as bulletproof as the headline numbers suggest.
Now, moving away from Wall Street for a second, we have to look at the consumer reality. The system isn't always as seamless as the commercials make it look. In fact, Carvana recently settled with the state of Connecticut for $1.5 million after racking up hundreds of complaints about delayed payments and missing titles. The online click-to-buy process is incredibly fast, yes, but the physical reality on the ground can be much messier. Sellers are reporting waiting weeks for their checks, and while Carvana's initial online offer for your used car usually looks amazing, their inspectors absolutely can, and regularly do, drop that offer by thousands of dollars right in your driveway for undisclosed mechanical issues.
And as Carvana deals with these logistical growing pains, they're making a really surprising operational shift, a pivot toward franchises. The ultimate online disruptor actually just acquired 7 physical Chrysler, Dodge, Jeep, and Ram dealerships. By stepping right onto the traditional turf of franchise dealers, Carvana is putting itself on a direct collision course with the exact legacy business model they originally set out to destroy. It's a really fascinating evolution of their strategy, and definitely one we're going to be tracking closely.
All right, let's wrap this up by looking forward. What is the outlook for the rest of 2026?
Well, management's vision remains absolutely sky high. CEO Ernie Garcia has firmly planted his flag with a massive long-term goal. He wants to be selling 3 million cars a year at a 13.5% adjusted EBITDA margin sometime between 2030 and 2035. Just to put that into perspective for a second, they sold just under 600,000 cars in 2025, so hitting 3 million means they have to scale up their entire operation, their reconditioning, and their logistics by a factor of 5, all while significantly expanding their profit margins from where they sit today.
So, how do they get there? Here's the roadmap of key catalysts you need to watch. In May 2026, a planned stock split could give the shares a nice liquidity boost. Then comes the really critical Q2 2026 earnings report. Management has promised sequential growth in both retail units and EBITDA. That's going to be the ultimate test to see if they can maintain their momentum strictly on operations without leaning on any one-time tax adjustments. Finally, by late 2026, they expect to fully integrate 6 to 8 more ADESA sites into their production line, and as we mentioned, that is absolutely vital for easing those reconditioning bottlenecks that are currently eating into their margins. Which brings us to the million-dollar question. Will Carvana's undeniable logistics engine outrun its accounting scrutiny? Can they smooth out those reconditioning costs, justify that massive valuation, and just quiet the skeptics with pure, undeniable growth? Or are the structural complexities of their model eventually going to slow them down? It is honestly one of the most fascinating corporate battles happening in the market right now. We want to know what you think. Drop your takes in the comments. Are you Team Bull or Team Bear? We read every single one. That wraps up today's Explainer on Carvana. For a sharper, even more candid discussion, be sure to join us on the full audio podcast. Thanks for watching, and we'll see you in the next one.